Layer 3 is the plumbing of global finance. The market infrastructures that move messages, settle cash, deliver securities, and guarantee trades, so the promises made by banks, brokers, and funds in layers 1 and 2 become final, irreversible facts. These rails are not headline makers, yet without them a $1 trillion bond auction or a $40 Uber ride would stall in midair. Central arteries for high-value payments come first. Fedwire in the United States, TARGET2 in the Euro area, CHAPS in sterling, BOJ-NET in yen, and CIPS in Chinese yuan are real-time gross settlement systems operated by their respective central banks. They guarantee same-day finality in central bank money, eliminating credit risk between participants. In March 2023, the European Central Bank merged TARGET2 with its securities platform T2S, shaving liquidity needs by allowing cash and collateral to swing inside a single technical stack. CHIPS, run by the clearinghouse in New York, processes nearly $2 trillion of large-value dollar payments a day using multilateral netting to slash liquidity consumption. Next is the messaging layer, led by SWIFT. Over 11,000 institutions in 200 jurisdictions rely on its ISO 20022 formatted messages to instruct payments, securities moves, and trade finance. When the G7 blocked several Russian banks from SWIFT in 2022, their dollar and euro liquidity evaporated overnight, proof that access to Layer 3 can be wielded as geopolitical leverage. SWIFT's monthly RMB Tracker shows how payment data itself becomes market intelligence. RMB flows jumped 22% in late 2024, lifting the yuan to the world's #4 settlement currency. Foreign exchange settlement concentrates risk into 2 brief windows each day. That risk is corralled by CLS, a New York chartered bank that settles 18 major currency pairs on a payment versus payment basis. Either both legs of an FX trade settle, or neither does. Average daily volume in January 2025 was $2.22 trillion, up 6% year-on-year, scale that dwarfs all crypto combined. For derivatives, equities, and bonds, the guardians are central counterparties, such as CME Clearing, LCH, and Eurex, as well as central securities depositories like Euroclear and DTCC. CCPs step between buyers and sellers, demand margin, mark positions to market, and mutualize default losses through default funds. Their design follows the PFMI principles published by CPMI IOSCO and monitored via annual implementation scorecards. In the United States, the Federal Reserve's 2024 Financial Accounts Note singled out CCPs as increasingly material nodes for systemic risk accounting. Regulators now track their balance sheet exposures as closely as they track megabanks. Retail instant payment rails add a real-time layer on top of the wholesale core. In the US, the FedNow service passed the 1,000 participant mark within its first year of operation, evidence that even the world's most mature payments market still seeks faster settlement. India's UPI processes over 12 billion transactions a month and, together with Pay Now in Singapore, Do It Now in Malaysia, Prompt Pay in Thailand, and InstaPay in the Philippines, will form the first 5-country Project Nexus corridor by 2026, enabling sub-minute retail transfers across a 1.7 billion person market. Innovation is accelerating. SWIFT's global ISO 20022 migration finishes in November 2025, boosting data richness for compliance and AI analytics. DTCC's Project Ion already settles select U.S. equity trades on a DLT network in T+0 instead of the traditional T+2, and its April 2025 launch of a tokenized collateral platform hints at how smart contracts might one day automate margin calls. Large banks are testing private settlement tokens, JP Morgan's Onyx handles intragroup dollar transfers. UBS and Standard Chartered back Partior in Singapore. Fnality prepares a sterling payment system using settlement assets backed one-to-one by central bank reserves. Each experiment aims to graft blockchain efficiency onto the legal certainty of existing payment law. Risk management is layered. RTGS systems eliminate credit exposure but require participants to pre-fund liquidity. Netting systems save liquidity, yet leave intraday settlement gaps, so they impose haircuts, loss sharing, and pre-funded clearing funds. CCPs set initial margin to cover potential moves and variation margin to crystallize gains or losses daily, hourly, in volatile markets. After the March 2020 Dash for Cash forced hedge funds to post $140 billion of emergency margin, CCP default waterfalls were expanded and collateral eligibility tightened. CPMI IOSCO now performs cyber resilience reviews after a series of ransomware attacks on Asian CSDs in 2024. Governance of Layer 3 sits at the intersection of public oversight and private ownership. Fedwire, TARGET2, and CIPS are public utilities. SWIFT, CHAPS, and CLS are member-owned cooperatives. CCPs and CSDs often list on stock exchanges, yet face real-time supervision by central banks and securities commissions under the PFMI framework. A failure at any systemically important financial market infrastructure, or SIFMI, would give regulators resolution powers similar to bank living wills, including the ability to impose haircuts on participant claims or transfer the business to a bridge entity overnight. Geopolitical fragmentation is testing the fabric. Russia's SPFS and China's CIPS vie to reduce dollar dependence. G7 sanctions force correspondent banks to layer extensive screening onto SWIFT flows, and data localization laws in India, Indonesia, and Brazil require domestic storage of payment message copies. Yet true parallel universes remain rare. Even sanctioned banks still settle most FX via CLS or Krona via RIX, because liquidity pools live where global investors congregate. Cyber threats top every risk register. The 2016 Bank of Bangladesh heist through SWIFT underscores how credential compromise can weaponize legitimate rails. Regulators now require minimum common features for endpoint security, real-time anomaly detection, and 24/7 kill switch authority. In 2025, the FSB will stage Quantum Day Zero exercises to rehearse a post-quantum break of current cryptography, accelerating migration to PQC algorithms and payment message signatures. Layer 3 also faces climate pressure. Exchanges and CCPs must price hurricanes, wildfires, and transition risk events into margin models. CSDs and custodians pilot green asset tags, so collateral pools can be filtered by ESG criteria. The ECB's new ECMS collateral system launched with T222-WASH, T2S, haircuts bonds lacking credible decarbonization paths, embedding climate risk into settlement eligibility. Interoperability with CBDCs is the next frontier. Pilot wholesale CBDCs in Sweden, France, and Singapore already link simulated central bank tokens to RTGS accounts and DLT-based securities platforms. The BIS's Project Mandala explores multi-jurisdiction sanction screening baked into smart contract layers, while Project Nexus tests how ISO 2022 metadata can bridge retail instant payment rails without handing a single tech vendor global dominance. Why Layer 3 matters to every practitioner. Miss a SWIFT cutoff and your bond coupon fails, triggering default clauses. Post thin collateral at a CCP, and a volatility spike can force a fire sale margin call. Choose a correspondent in a gray-listed FATF state, and settlement banks may refuse your wires. Operational mastery of these rails often separates a seamless transaction from a public embarrassment. To integrate safely, confirm rail access early. Ask counterparties where their funds will clear, Fedwire, CHIPS, or an onshore RTGS. Map margin waterfalls. For cleared trades, Examine default fund layers and liquidity resources available to the CCP. Stress cyber scenarios. Ensure secondary messaging channels, like Swift Relationship Management application, can bypass a compromised primary BES. Monitor ISO 2022 adoption. Richer data fields enable AI sanction screening, but also expose privacy and data quality risks. Track DLT pilots cautiously. Tokenized settlement assets offer speed, but depend on central bank or custodian convertibility back to fiat reserves. In sum, Layer 3 is the circulatory system of modern finance. RTGS ventricles pump central bank money, netting veins recycle liquidity, messaging nerves route instructions, CCP immune cells absorb counterparty shocks, and emerging DLT capillaries promise faster healing. Its design, public utility governance fused with cooperative ownership, leans on the trust created in layers 1 and 2, but repays that trust by delivering atomic finality billions of times a day. Understand its protocols, monitor its evolution, and you control the heartbeat of every cross-border deal you will ever do.